Right then, let's talk about tariffs. Specifically, let's talk about former President Trump's tariffs, because honestly, they're the gift that keeps on giving, mostly headaches and higher prices, it turns out. The basic idea behind these tariffs, we were told, was to give American industries a bit of a leg up. You know, protect the homeland, bring jobs back, make America great again, and all that jazz. The theory goes that by slapping extra taxes on goods imported from other countries, particularly China, those foreign goods become more expensive. This, in turn, should make American-made products look like a better deal, encouraging everyone to buy local and boosting domestic manufacturing. It's a beautifully simple idea, isn't it? Almost too simple. The grand plan was to rebalance what Mr. Trump often described as unfair trade relationships. China, with its massive manufacturing sector, was a primary target. The tariffs were meant to be a bit of a stick, encouraging Beijing to play nicer on trade deals. So, these import duties were rolled out, affecting a vast array of products, from steel and aluminum to electronics and clothing. The intended purpose was clear: make foreign stuff pricier, American stuff more attractive, and somehow, magically, everyone in America wins. Except, as we're about to see, the winning part seems to have got a bit lost in translation, especially for your average shopper. Let's get down to the brass tacks of these tariffs, because the numbers themselves are quite something. Initially, in April 2025, the Trump administration escalated things dramatically, threatening a rather eye-watering 145% import tax on a wide range of Chinese goods. Yes, you heard that right, 145%. Thankfully, common sense, or perhaps some frantic backroom dealing, prevailed slightly. This figure was later reduced, and I use that term loosely, to 30%, on top of an existing 10% baseline tariff. But China wasn't the only country in the tariff spotlight. As companies like Walmart had been diligently trying to diversify their sourcing away from China to avoid previous trade tensions, they'd increasingly turned to other manufacturing hubs. Countries like Vietnam and India became more important. So naturally, the new tariff regime decided to include them too. Goods from Vietnam were hit with tariffs of 46%, and items from India faced a 27% levy. The reach of these tariffs extended even further, impacting everyday groceries. This broad application meant that the cost pressures weren't confined to one sector, but were being felt across a wide spectrum of consumer goods, making it harder for retailers to shield customers from the impact. Walmart. The name itself is practically synonymous with everyday low prices. It's their mantra, their business model, their solemn vow to the American consumer. So, when a company that has built its entire empire on squeezing pennies out of the supply chain starts talking about raising prices, you know something serious is afoot. And that's precisely what happened in May 2025. The retail giant, faced with the Trump administration's latest volley of tariffs, had to break the news. Prices were going up. This wasn't a drill. This was the direct consequence of those import duties we've been discussing. Duties described by some as the highest since the 1930s. When a company the size of Walmart makes a move that could affect nearly every household in America, you tend to listen to what its leaders are saying, and they weren't mincing their words. Walmart's chief financial officer, John David Rainey, put it quite plainly. He stated, "We're wired to keep prices low, but there's a limit to what we can bear." This isn't some corporate jargon. It's a clear admission that even Walmart, with its immense buying power and sophisticated supply chain, couldn't simply magic away the multi-billion-dollar impact of these new tariffs. Then you have the big boss, CEO Doug McMillon. Speaking to investors who are generally quite keen on things like, profits, McMillon was equally direct. He explained, given the magnitude of the tariffs, even at the reduced levels announced this week, we aren't able to absorb all the pressure given the reality of narrow retail margins. This highlights the fundamental problem. Retail is a tough game with tight margins. Section 5. Trump's Twitter. Sorry, taunts, eat the tariffs. Now, how do you think the former president, the architect of these tariffs, reacted to Walmart's rather predictable announcement that prices would have to go up? Did he perhaps engage in a thoughtful dialogue about the complexities of global trade and retail economics? Of course not. Instead, over the weekend prior to May 19, 2025, Mr. Trump took to his platform of choice, Truth Social, to issue a public directive, or perhaps more accurately a public scolding, to the retail giant. His message was characteristically subtle. He essentially ordered Walmart not to raise prices, which is a bit like ordering the tide not to come in. In a memorable post, Trump declared, Walmart should stop trying to blame tariffs as the reason for raising prices. Between Walmart and China, they should, as is said, eat the tariffs and not charge valued customers anything. I'll be watching and so will your customers. The capital letters, the exclamation marks, it's all there. This statement is fascinating on so many levels. Firstly, it's a direct command to a private company on how to set its prices, which some might view as a rather presidential overreach. Secondly, it rather conveniently ignores the basic mechanics of who actually pays a tariff in the first instance, the importer, that is, Walmart. Section 6, the checkout shock, how your shopping bill got trumped. So what does all this high-level bickering about tariffs and who should eat them actually mean for you, the average person just trying to buy some groceries or a new pair of trainers? Well, it means things get more expensive, it's really that simple. When Walmart, a company that moves an incredible volume of goods, says it has to raise prices due to tariffs, that's not a theoretical exercise. It translates directly into higher numbers on your receipt at the checkout. And we're not just talking about big-ticket items. Even everyday essentials started to see price bumps, making the weekly shop a bit more painful. Take bananas, for instance. A humble, affordable fruit, right? Well, with tariffs impacting goods from countries like Costa Rica, the price of bananas at Walmart reportedly increased from around 50 cents a pound to 54 cents. Now 4 cents might not sound like a lot, but multiply that by millions of pounds of bananas sold, and consider that it's an increase on a very basic food item. Then there are more significant purchases. Section 7. Dodging the duties, Walmart's supply chain scramble. Faced with this barrage of tariffs, Walmart wasn't just going to sit there and passively watch its costs explode. This is a company renowned for its logistical prowess and supply chain efficiency. So, naturally, they explored ways to mitigate the impact. One of the primary strategies, even before this latest round of tariffs, had been to reduce its reliance on China. Back in 2018, around 80% of Walmart's imports came from China. By 2024, they had managed to whittle that down to about 60%, diversifying their sourcing to other countries like Vietnam, India, and Mexico. A sensible move, you'd think. However, as we've seen, the tariff man cometh for all. The new tariffs slapped on goods from Vietnam, 46%, and India, 27%, rather threw a spanner in the works of that diversification strategy. Section 8. History lessons and economic headaches, tariffs, then and now. Now, tariffs are hardly a new invention. Governments have been using them for centuries, sometimes for revenue, sometimes for protection, and often with rather mixed results. If we cast our minds back, the most infamous example often cited is the Smoot-Hawley Tariff Act of 1930 in the United States. Intended to protect American farmers and businesses from foreign competition during the Great Depression, most economists now agree that it spectacularly backfired, worsening the Depression by inviting retaliatory tariffs from other countries and strangling international trade. While the current situation isn't a direct parallel, the historical lesson is that tariffs can have unintended and often detrimental consequences that spread far beyond their initial targets. The core economic argument against widespread high tariffs is that they act as a tax on consumption and can distort efficient market allocations. Section 9. The bottom line, uncertainty, unaffordability, and what's next. So where does this leave Walmart, its millions of customers, and the broader American economy? The immediate impact is clear: increased prices on a wide range of goods. For a company whose entire brand is built on always low prices, this is a significant challenge. It forces Walmart to navigate a treacherous path between absorbing unsustainable costs and alienating its price-sensitive customer base. The company's financial reports for the first quarter of 2025, which ended April 30th, showed revenue up 2.5% to $165.61 billion, but net profit was down, compared to the previous year, from $5.10 billion to $4.45 billion, hinting at the pressures even before the full force of the May tariff announcements. The uncertainty created by this chaotic environment, as Walmart termed it, is perhaps one of the most damaging aspects. Businesses thrive on predictability. When tariff policies can change dramatically with little warning, it becomes incredibly difficult to plan, invest, and manage supply chains effectively. Walmart even refrained from issuing a profit outlook for the upcoming quarter due to this volatility, though it maintained its full-year guidance from February 2025. This lack of clear foresight from such a major economic player is a worrying sign, reflecting the instability that these trade policies have injected into the market. For American consumers, particularly those on fixed or lower incomes who disproportionately rely on Walmart, the consequences are very real.